Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Once again, it's Saturday, so another weekly market recap, I suppose. Welcome back. Kind of a busy week from the economic calendar standpoint. We got a bunch of data points which were released this week. So I think, overall, the market didn't really move a lot, or, maybe less than expected. I guess when you got things like CPI, PPI, retail sales, people might expect a much bigger reaction, especially from traditional markets. While instead, at least, from an overall standpoint, it felt to me like most of what came in was kind of priced in at a point. But, without wasting too much time, let's just jump into the economic calendar and look at what we are talking or hinting of. So this was, of course, the star of the week, I guess, inflation, CPI. So the month over month, it came in at 0.3%. It was in line with expectations, so nothing particularly relevant there. If not, again, if you just check at a trend, you see that we are going through these periods where it goes up a bit and then it plunges. It went up a bit and then it plunged. It went up a bit and then it plunged. So even if you zoom out, let's say on a 5 year type of a time frame, you see that, after inflation peaked, we didn't have a lot of month over month, let's call it particularly worrying type of data. Now, this time around, should also point out that at this point, if you check the months for May, June, and July 2024, you see they were particularly low reads. So it might be a little bit of a base effect is in play now. And even, a slight or a smaller variation in present inflation could, generate a little bit of a higher rate because we are looking at, especially when you look at the year over year, we are looking at the present data compared to data in the past which were particularly low. I guess it's much more evident on a year over year comparison at the end of the day because the month over month, it just compares the present month with the prior. So it's a little bit more short term. There is a little bit more noise, but if you go and if you check the annual rate of inflation, as you can see, we are basically particularly comfortable now in the range which we were in pre-pandemic at the end of the day. So I don't remember anyone talking about, I mean, if not Powell, when he was saying we were nowhere near the neutral rate. And then, of course, all of a sudden we were. But, you know, apart from him and a few, I guess, financial media outlets, I don't remember a lot of people screaming in 2018-19 that we were on the verge of hyperinflating, while instead it looks like now, although we are in the same range and we are actually coming down from a peak, at the very tiny little piece of article or news about something which could be potentially inflationary, everyone is kind of panicking like we are going to have Weimar Republic type of inflation. I guess this time around it's because of tariffs, right? We had tariffs before, right? We have seen the trade war that Trump unleashed against China in his first term. It wasn't nothing comparable to what we are seeing now, of course, but still, kind of, the same principle applies in my view because it's easy to say it was a kind of a nothing burger. It's easy to say it now in hindsight, but you always need to remember that people don't live, uh, you know, in what could be 5, 10 years from now. They tend to live in the present, and they're always particularly worried. So, we will get back to the subject of tariffs, but before doing that, just have a look at all the data for this week, right? So moving on, we got what the core inflation rate, which again, just check the trend. Is it high? Is it low? I mean, 2.9. It came up a bit, like 10 basis points from the previous what three reads. Is it a massive problem if you consider the trend? I don't think so, right? Again, it's kind of the same type of argumentation you can make for the headline CPI at the end of the day, in my view. Now, I think if you check what happened, especially on Monday in equities, one of the biggest driver beside the raging bull market we are in and all the rest of the particularly good sentiment and that animal spirit we are witnessing now. But I think that specific day, uh, what could have driven the market higher? It was these peso data right here, which to me it's not particularly relevant, but it came in positive for the first time after what, maybe 5 months. And again, if you just check the description, it's a bunch of businesses around what, the area of New York. So is it a good proxy for the overall broad economy of the US? I guess no, but again, to some degree, it just confirms my thesis that all those worries out there, the market particularly, it's particularly efficient in shrugging them off, but at the same time, the market can be attached to every single tiny piece of positive news. So basically every excuse for a rally it's taken. So again, it's just, to me, it's just a manifestation of the bull phase we are in and how the risk appetite is out there, both on the retail side and at this point, for institutionals that we were discussing a few months back. They needed to catch up with their allocations because they were kind of shaken out with the April drop, and they didn't put money back in, right, up until recent times. So again, I guess there is a little bit of a FOMO, performance chase in these markets, and the reaction we had to this piece of data, I think it was another testimony of it. Now, if you then check what happened the day after, so inflation was on Tuesday, this one was on Wednesday, we got PPI. Now, PPI came in at 0, all right? The headline. The core, I think it was, let me check. I don't have the core right here, but I think, on the top of my head, uh, it should be similar, probably maybe a 1 basis point difference in between the core and the headline. But the bottom line for me would be if you got 0 PPI, right? What does it tell you about the overall state of inflation or potential inflationary pressures? Because to me, that suggests we got none. How can you generate inflation overall if the very specific way from which you should start, right, it's not seeing it? Because, consumers should be supposed to pay higher prices and then having to pass them on to the consumers. But if you don't see inflation on the producer side first, what should they pass on to the consumers, right? I mean, can they raise prices anyway just with the excuse of tariffs in order to kind of price gauge a little bit and making a bit more of a profit? Yeah, I guess they could, but if you don't see inflation actually going up in a very sustained way, that should tell you that they are not. Now, why are they not? Maybe because they don't want to lose volumes, because they see consumers might not be so, you know, attracted to some price increases, especially now. So I think again, I don't see a case for inflation to come back in at full force, as Powell might be scared of. So at least for me, it's just another proof that tariffs up until now are not really showing any type of inflationary consequence. Now, consider that at the end of the day, PPI for the year so far, 2025, it's down 2.3%. So again, I don't see when you start to talk about being data driven and looking at the hard data and whatnot. Are, these are data, right? Where is the inflation? Why are we so scared of inflation at this point? All right. Does it mean we are never going to have inflation going higher again? No. It just means, if you look at it at the very short period, you're not seeing it. And again, keep on saying, but it's gonna come, it's gonna come, it's gonna come. Yeah, it's kind of the same of saying like inflation is transitory up until the point it wasn't. Right? This time around, it's in reverse. Inflation is going to come up until the point it doesn't come, and actually you keep on looking at disinflation. And maybe one day you wake up in a scenario where you're witnessing actual deflation. What about that, right? Okay, many different narratives. I do believe, right? It's just simple logic. If you don't see it in the data, why would you be scared, right? For me, it's just like that. But maybe, I don't know. I don't have a PhD. I don't work at the Fed, so maybe I'm just wrong. Then what we got, yeah, still the annualized price, PPI rate of change, which again, it looks to me like it's been going down for the entirety of 2025 after peaking in January, right? So again, same theme there. Then we got retail sales. Retail sales this time around, they were kind of, if you want to call them good, they were positive at the very least. So um, it's 0.6%, so 60 basis points. If you then adjust for inflation, because remember these data, they give it to you in nominal terms. If you then consider the 0.3% inflation rate for the month, this should be 0.3 at the end of the day in real terms. Is it good? Is it bad? It's not negative at the very least. So maybe U.S. consumers they still retain a bit of fuel to keep on consuming, but it's not something to write home about, right? If you then check this should be the year over year, right? Yep. So it's what? 3.9, but again, if you consider CPI year over year came in at 2.7, when you adjust this one, it should be what? 3.9 minus 2.7, 1.2. And again, I'm just trying to figure out, right? I'm not necessarily expressing an opinion one way or the other. I'm just trying to doubt that or to question that. 3.9, when you adjust it, it's 1.2. Is it good or bad for the overall economy or for the projections or assessments you could have for the real economy over the next, 6, 9, 12 months? I don't know. I'll let you be the judge of it. To me, it's a little bit of on the neutral side right now, but when I look at a trend, I can't be particularly enthusiastic about it, right? Again, does it mean we're going to have a recession and all the rest, the doom and gloom, the fears and whatnot? No. I'm just saying, the economy, it's just, again, it's another data which tells you the economy is slowing down. But there is a difference in between slowing down and outright collapsing. So always remember that. Jobless claims on a Thursday, they came in, we've seen this peak and now we see this low down in the claims, which is good at the end of the day. It should give the labor market a little bit of a reprieve, I guess. Although, again, I've always been particularly skeptical about the resilience. Yeah, the resilience or resiliency, whatever. You got the gist of it. But, the potential fragility, let's put it this way, of the labor market, right? Now that would seem to counter that, but yeah, it seems to be confirmed even in the 4-week average. But then again, I think the most important among these three should be this one, so the continuing jobless claims. Because for me, again, I keep on looking at it and thinking, yeah, okay, the headline could go up and around, whatever you, but this one, it's telling me that more people are getting into or getting onto the unemployment line and they don't come off of it. So, you know, I look at these and I think, okay, maybe over the last 3, 4, 5, 6 weeks, you didn't have more people going unemployed, but at the same time, over the same period, you didn't see the same people which were unemployed back then getting back into the labor force or getting back to have a job and therefore a salary, a paycheck, a wage, or whatever you. So to me, again, it's not the best sign ever, to put it kind of lightly. All right. And then we go ending up the week, Michigan consumer sentiment release, which again came in pretty good compared to the most recent reads. But if you check it out on a much larger scale, is it particularly good? I don't know. Like, it's obviously, if you look at it in the context of this 1 year only, I mean, it looks like we bottom out and we are picking up. But again, if you start to zoom out, I don't think overall this is a super good type of sentiment overall, right? Now, okay, there's always the same type of caveat, right? That when you run these surveys, it depends a lot on the type of people you interview, the way you actually ask the questions, what type of questions on what topics. So the tone of the question, that could often lead the answer. To be fair, it's just a psychological game, right? Call it a mentalist type of game if you wish. But nonetheless, it's kind of like inflation, right? You can say inflation for you is overestimated, underestimated, doesn't matter. The market at the end of the day is going to look at the data for what it is, and it's going to react to the data. Speaking of inflation or data in general being over underestimated, let's get back a little bit to one of the favorite tool throughout the inflation period for those calling for Weimar Republic type of inflation. Now, Trueflation right now, it's giving you pretty much 2% type of read against the 2.7% of the establishment. Now, again, this is always funny to me because, when inflation was at 9%, these two right here, it was maybe reporting, I don't really remember precisely, I'm just trying to remember on the top of my head, but maybe it was reporting like 10, 11 or something like it, okay? And people were like, see, the establishment is lying to us. The real rate of inflation, it's way past what they are trying to communicate. So again, inflation is way higher than what we are told. Okay, now though, if you follow the same logic, unless you are again cherry picking the data, inflation should be kind of lower compared to what they are telling you, right? So again, how does it work? Uh, is this just valid when it's confirming your thesis and it's not when it's denying it? Again, I keep on going back and around to this one because it's a nice game to play. Look at what people are telling about a specific tool or data point relative to the time when they are looking at it, and compare, relating that to those people beliefs or narratives or thesis in a way. Okay, so again, if you now remember this 2% number for a minute, all right, because we're gonna try to link it to what we are going to see in the next chart, right? So inflation expectations as shown by the break evens, it looks like we got a little uptick, but again, this is expectations, right? But again, we've seen the hard data. They don't seem to show up a lot of potential inflationary pressure for now, at the very least. So again, now let's have a look at the GDP Now tool, which is now forecasting 2.4% for Q2. Now, I don't remember exactly when we are going to have the data. I didn't check, but assuming Q2 already ended in June, right? I guess we are not that far off from having the GDP print for Q2. Now they are estimating 2.4. If you remember, I was particularly vocal in saying that, to me, at the end of the year, so the entirety of 2025, I'm expecting a range in between 1.8 and I told 1.8, 2.3. Okay, so for now, it's still a little bit above it, but we'll see. It's just some sort of a guessing game. It doesn't have to be exact. It's just a little bit of a forecast on my own. All right, we'll see. But what I would say is, look, if this data, assume this data is correct, if it's telling you 2.4%, right? And the establishment is telling you that inflation is at what? Uh, the analyzed rate was 2.7. That should give you, if you make an addition, 5.1, right? So then you ask yourself, are rates too high? If let's say the 10 year or the 30 years now are again approaching the 5% level, um, I mean, you could build up a case by which yields are right where they should be. If interest rates should be a reflection of growth and inflation expectations, right? If you add up CPI and GDP, it looks like yields are just tracking inflation and economic growth. Now, you would then need to assess if you think this inflation trend or economic growth trend will keep on going, to then assess if yields should keep on climbing to the upside. But, uh, there is a lot of discussion in between yields. Are they high enough? Are they low enough? Are they right in the middle? I guess, they are just doing the job at the end of the day. They are just tracking the two components, which are the leaders, indicators, in order to grasp what the quote unquote right uh, level for rates should be. Okay. So other than that, I don't think there is anything else to see on the economic calendar. So let's just jump into the charts for the week. Let's start out as usual with our dearest DXY dollar index. All right. What do we see? Well, we've seen the DXY keep on going to the upside this week. Started out on Monday with this tiny little candle right here. Then we got a massive expansion to the upside on Tuesday. Wednesday, Thursday was a little bit of a rangy behavior, but you know, overall, this level was here. It looks like we kind of reacted to it. Now it's much more evident if you zoom in, I guess. Let's try to go on the 4 hour. And what you see here is basically kind of the same pattern of reaccumulation at the bottom, right? You got dealing range, deviated, reclaimed, up we go, very orderly, very efficiently. Then we started to reclaim this old type of support right here. You see the reclaim here and then the push higher, the initial reaction at the level we were looking at. And then we got a little bit of a spike. Now, this was interesting, but you can't really appreciate that on the daily time frame. You need to zoom in. But if you look at this price segment right here, right, you see this very impulsive candle shooting down and leaving behind it two gaps, essentially. That's the basic scenario where you go. Now, I don't want to mistake the definition, but it's basically a twin gap, double gap, or one gap in between the other. So you got an internal gap and an external gap. Now, the internal gap would be this one, right? Because that's the first area of pricing efficiency that you see on the chart. Now, there is no pullback throughout all these segment right here. So again, even the area below it, it could be categorized as another type of gap, right? So you got this massive impulsive candle, which leaves an inefficiency behind in this segment right here and in this one, right? So when you reapproach that area, what you see is that you see an initial reaction at the external gap right here. And then after that, price shoots to the upside, fills in the external gap or retests it, and then you have your massive rejection. Now, again, it's easy to say now, I'm zooming in even more to see if you can appreciate that even more, but it's easy to say now, okay, but we got news right here, right? Otherwise, you wouldn't see that massive spike to the downside. And I know there was news. Now, I don't remember what it was about. Probably, I don't know if it was Trump talking about firing Powell or whatever you, but the concept sticks. Even if we didn't have news, most likely on a probability base, you would have seen a little bit of reaction at this level right here, right? So again, that just gives you the context for, where to expect XYZ or how to prepare when you see price approaching A, B, C level or whatever you. Now, again, as we always say, sometimes the chart are just telling you something, and what you need in order to see the move that you are expecting, it's just a catalyst. And like in this case, we might have a little bit of a catalyst, news driven, event driven, and you see the huge price movement. Now, at the end of the day, again, if you get back on a daily time frame, what you see is that that level still held and we kept on pushing to the upside. Now we closed down the week as for the DXY with a little bit of indecision, but I think we are still on track to keep on pushing through. Now again, sometimes there are some areas you just look at the congestion of this area before, right? So naturally, in order to chew through it and try to get to the other side where you got these clean lows right here, it might require a bit of time. But uh, if things really start to snowball, and you remember the thing about the massive bearish sentiment, the positioning which was way upside to the downside on the dollar, I still think we got potential to get back to. I guess the reasonable target would be 100, right? Above this high right here. But on a macro scale, I would like this one better. Like 101, 102. I think it might be on the card. Sure, as anything else, it's always a matter of if this and that. So can we reclaim this level? And we did and push higher. Can we now reclaim the other one? If and when we can aim higher. So ultimately, can we reclaim these highs and starting trading above them and starting to set up for another push? So again, you kind of have your price action marked out for you. So just wait for if this and that. I guess it's the safest way to approach it. So now you can establish targets, triggers, and points of invalidation. All right. Now, overall, foreign currencies, conversely to the dollar, they kept on pulling back a little bit. Pretty much all of them. Maybe the British pound a bit more than the euro. We were looking at this relative strength of the euro compared to the pound sterling for now. The Japanese yen kept on plunging relative to the dollar. So again, we kind of avoided that warning sign as for the liquidity conditions or the potential deleveraging in the monetary system for now, which is good at the end of the day. Dollar Canadian, it's just going sideways for now. So kind of, I think we might have just established a new dealing range on this one. At the very least for now, up until the point we either break down from this low or break out of these highs. But it's not particularly bad for now. So we'll see. I think we are at an inflection point. If you remember the analysis of the DXY, right? Because if these one it starts to push through to the upside, foreign currencies should keep on plunging. Doesn't have to be a plunge like down 2-3% in a day, right? But they would keep on drifting to the downside, right? They are just gonna move in the opposite direction. Um, BRICS currencies, other foreign currencies, just completely avoid them for now. I think, we have been looking at them over the last 3-4 weeks, and there was no particular change or, sharp movement, which was particularly impressive, so to speak. Maybe the Australian dollar, if you want to notice that it was looking like it finally reclaimed this level. It tried 2 times and it failed. So again, probably it should. I mean, considering how the move was structured, if the DXY really shoots up, all these lows are going to be targeted, I guess. Would be just a failure. We got a massive pickup of liquidity, attempted to break to the upside, not sustaining it. coming back down to fuel the tank a bit more. Bounced off of a good area right here. Another try, no new highs, failed. So best case scenario, if you are a bull on the Aussie dollar right here, it's for it to maintain the range. Otherwise, I think this low, it's in danger. And, you know, after that, we might get back to retest the previous relevant level right here, right? Now, let's have a look at oil. Oil, we didn't have huge expectations for oil. I guess, the assessment was, it looks like, I'm quoting myself again, it looks like it's trying to establish a new dealing range in between the 65, 66 and the 70s. So again, we got on Monday a spike right into what? 69.76. No, so 66, 65, something like it. And immediately it pulled back, but it spiked to the other direction. So to the downside, it spiked into the 65.30 something to maybe more 65.40, and it bounced back toward the mid side or the midpoint of the range. So again, closed the week with a little bit of weakness, but still around 66. So I I don't have a strong opinion on oil for now. I would wait for it to just resolve this range. If it keeps on staying in this one, I already assessed the pros and the cons, right? If you're looking at the implications for the overall energy market and therefore the broad economy, because energy is the core of everything. At the end of the day, you can't do shit without energy, so it's something which impacts everything in the economy. And for the energy producers, so companies which are digging oil out of the ground and all the rest. So nothing changes there for me at the current moment in time, up until the point this situation here is resolved one way or the other. All right. Um, okay, would you just take a little bit of a side here? I think overall, although there is no technical trigger for one direction or the other, my bias would be a bit more to the downside. Not massively, but it might be we see like 64, this level right here being retested once again. Don't have a specific timeline for it. It's just, call it again, gut feeling. Hints of said bias, all right? Not huge, but slightly biased to the downside over the coming weeks. Again, don't have a specific timing for it. Again, which makes the whole kind of not really relevant, but yeah, this is what I got. No clear ideas, right? Bitcoin, which well, had a very good move to the upside here. We tapped into what? 123 was the top, and then what? Then we kept on going sideways here. But again, sideways after a breakout like this, it's good, right? The market was auctioned to a new level. We are now starting to build up volumes at those levels, so transactions are taking place without an immediate type of sell-off, which usually tells you that you are kind of starting to build up acceptance at a new price level, which just happens to be higher than the previous one. So again, the bullish market still in play. Could we have a bit of a pullback sooner or later? Probably, yeah. I mean, at a point, we have seen Bitcoin over the last, yeah, well, years at this point. It's trading particularly efficiently, right? And again, I think this is still a sign that, we have been praised for institutional to get into this market, and now this market it moves more and more like a trad market, right? Uh, I I don't I wouldn't categorize it like it's moving like the stocks or it's moving like a commodity, it's moving like a currency, but beside the profile or the label you would attach to it, but you can clearly see, it tends to get inefficient at times, but overall, slowly but surely, all those price inefficiencies which are left out or left behind, sooner or later, are just repaired or filled or rebalanced. And then, the market, therefore, I guess it's more healthy. All right, let's put it this way, because when you see a market like this going up overall, slowly but surely, with it's with no major inefficiency or gap in delivery left behind, to me that is a solid structure. That is a market which is maturing, and again, it's showing you a pretty clear direction, and it's going there kind of, even for Bitcoin. If you remember Bitcoin, maybe 4 or 5 years ago, if you're already around the cryptocurrency space, many people would have told you that periods like these were absolute boring, right? Which, don't get me wrong, for Bitcoin they might be, but for the long term, I think that is a sign of a market which is getting a bit healthier, right? Now, yeah, I don't think we got any particular dangers as for Bitcoin. Just by the nature of the asset, if you get a pullback, okay, it might seem particularly scary, but just because the volatility, it's particularly higher than other assets, all right? But just focus on the structure. This is a bullish structure, so there is no there is no reasons at the current moment in time to be bearish at all. Now, are there reasons to be massively bullish? Um, I guess it depends on your time horizon, of your expectations, all right? Like, are there reasons to be massively bullish like tomorrow or the day after tomorrow? Um, Maybe not. Like, again, I said that we are just building up acceptance, so it might takes a bit more. So maybe we just consolidate a little bit more, and even we try to pull back a little bit, right? But if you're looking at these right now, let's say you just take a photo or a picture of it, you look at it and you start thinking, where do you see it over the next 4, 6, 8 weeks? I guess it would be very hard to find people which would tell you lower. So again, the bias should be naturally to the upside. Now, gold is hanging in there for now. Um, I guess there is no particular surprise in gold. We started out the week as we anticipated, right? Because if you remember last week, the analysis was, look, we retested this resistance right here, all right? And we saw rejection. We formed a higher high, all right, compared to the monthly low, at least, the June lows, right? We didn't even reapproach them. We kept, or we tried again, another attempt at the same level. And what we said was, look, it might be you need to work this level out, and you could see another little tiny push, a rejection. But again, if you keep on seeing rejections, and each one of them, it's, let's say, weaker or has a very, a smaller magnitude than the previous, that just means that the liquidity on the sell side is eroded, and over time price should manage to breach through and get back above the level. All right, and it looks like that's what we've seen. I mean, we've seen Monday, Tuesday, sharp drop, and then Wednesday, another test into the level, very sharp. Now the day closed on a rejection, right? But again, then you see on Thursday it tried to go down and was immediately bought back up, and Friday closed with a little bit of a doji. So there is no sign for now that this market is going to shit itself. Fundamentals, in my view, are still particularly solid. Now, in the very short term, you could check the previous weekly low, unless you want to check this one, which was the current weekly low, which again next week is going to be the previous weekly low, so you would need to shift things ahead. Right? Yeah, but again, you could start to look at every single low, right, or swing low, and up until the point they are defended, you're not looking at a change of behavior, right? So again, try to look at it this way. If you wanna, I'm not saying this is the way I do it. I'm just saying for the general public, I'm sure there would be many people which would look at it this way, right? Higher lows, you got some sort of a resistance right in here. It looks like your typical ascending triangle, which is a reaccumulation type of formation. So up until the point you don't see a breakage of this trend, you should maintain an upside bias. Probably it won't run the same as something like Bitcoin would, but again, nonetheless, don't bet your farm on a massive drop in gold price, let's say over the next week or 2 weeks at the very least, right? Uh, just wait for the market to confirm that. If you really like, if you are bearish oriented on whatever, just wait for confirmation. You don't have to catch the absolute top, right? As a short seller, same as you don't need to catch the absolute bottom as a buyer, right? It's just the way it is, right? So that would be it for gold, I guess. All right. So I think we could move to interest rates and check what happened. So overall, rates kind of pushed to the upside this week, especially the long end. We've seen, we got this massive bullish candle on Friday, and they got continuation Monday, Tuesday. Then we got a little bit of a top, a very, very short-term top, right? I need to measure the words particularly careful, right? But you know, the long end, as usual, it looks a bit more bullish compared to all the rest. So your medium end and your short end. Now, I think a lot of what we've seen in yields was a little bit of a reflection of what we've seen with the big beautiful bill and all the rest, as I hinted at last week, I guess. Now this week we got that that was nice. We got Trump basically, telling people that he was, uh, let's say, gathering information, legal information, about the opportunity or the possibility of actually firing Jerome Powell. Now, look, this is another very difficult topic in my view for many people because it it gets you, or at least it taps a little bit in your political bias. It's easy for me to say because I'm not American, so I might have a sympathy for that man or the other, but overall, I'm not so rooted in the conversation to feel like my sympathy for that character or the other should impact my own assessment of these charts. I think overall, the best I can do is to look at these and say, what could the market think of this unprecedented type of event actually unfolding itself, aka the president actually firing the chairman of the Fed. Um, well, look. First of all, I don't, I don't think it's going to happen. There is no legal support to that. Trump talked about potential guilt in case Powell was accused of fraud. The only fraud I can think of is that the Fed is renewing or building up a new, no pun, but building in order to, you know, set up a new headquarters and whatnot. And they are spending a hell of a lot of money, which again, it doesn't necessarily put you in a good light, you know, in the taxpayers' eyes. But at the same time, is it really fraud, or could you build up a case for it to be a fraud or inappropriate use of taxpayers' money? Because if that's a fraud, you should basically put the entire US government under trial. Not just the current one, but basically all the administrations over the last 30, 40 years. I don't I don't see any administration or government in the Western world, so US, Europe, all the rest, which actually made a good use of taxpayers' money. So what are we gonna do, right? Right? So I think at the end of it, that what Trump did was kind of a test. Like, he came up with this idea, yields kind of spiked, and then, bonds sold off, and he had to backpedal immediately, like saying, no, 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 I'm not saying I'm going to do it. I'm saying it could happen if this and that, but for now, I'm seeing that possibility as highly unlikely. And then, of course, you've seen yields, you know, pulling off a little bit. The same type of behavior we've seen in the equity market. The second he came up with that tweet, the market just tanked. 1 hour later, it basically backpedaled once again, and the market kind of recovered. So I think, even if he wanted to, right, I don't think he's going to do it, because if that was really a test in his mind, like, I'm going to just pull out this tweet, see how the markets react to it, right? And yeah, I guess the market responded. And to me, it kind of makes sense. Although, whatever what you think of Wall Street and whatever what you think or I think about the Fed, I'm not particularly sympathetic with the Fed, but I think at the very least, Wall Street wants an appearance, right, of an independent Fed. And so, if all of a sudden there is no more, still talking about that appearance, right? I think they're going to react particularly badly, right? So I don't think it's going to happen. I think overall, what is going to move rates, as usual, it's not going to be the Fed, it's not going to be Powell, it's not going to be Trump, especially if you consider he just stated that he would like to see rates dropping 3%. And on Friday, closing down the week, he said he would like rates to be below 1%. The, in I mean, what do you mean? Like, in one blow? Like, imagine July or September meeting, Powell or whoever at this point, right? Just playing the game of hypotheses and extremes. But anyway, the Fed chairman comes out at the FOMC meeting during the press conference, and he says, you know what? I think we just dropped Fed funds by 3%. So it was 4.25, 4.50. Yeah, it's now 1.25, 1.50. How do you think how do you think the markets would react? If you want a bit of insight, just get back to September 2024 when the Fed started dropping rates, right? Now let's zoom out on a weekly time frame, because it was this period right here, September, I guess. Yeah. So they dropped from September to, I guess, over four meetings, so probably 4 months. So they dropped cumulatively 100 basis points. So you might say, okay, so the entire yield curve went down 100 basis points. Instead, when you look at the 10-year and your 30-year, it looks like they went up by 100 basis points. So I don't know if the ultimate goal of Trump is bringing rates lower. If stuff like firing Powell or demanding rates, or Fed funds in this case, all of a sudden to drop 3% would bring the results he's looking for. Considering next time they drop by a significant amount, the market looked through it. And whether you think the market was right or wrong, but anyway, that was the market reaction. They thought dropping rates with all these inflation threats, it was a little bit too premature, and they started to price in higher inflation expectations in the future. Or you could also look at it like they they read through it, and they said, well, if you start losing in financial conditions now, while the economy is still kind of on fire, that should bring even more growth. So higher inflation, higher growth, and what we circle back to the beginning of the video. We should have higher yields, right? So I don't know how it's going to end up. A lot of it, to me, it's just political theater. It's a for sure, but nonetheless, I can't deny it's enticing to watch, right? So there is not a lot more to say. The bonds, just moved inversely to the yields as they usually do. So yeah, I don't think the fundamentals for rates. I think if you think about a slowing economy, rates at a point should come a bit lower to reflect that. Again, you would need to look at the hard data first, like GDP, inflation, and whatnot. But I don't think, like, I don't think the US it's going to grow at an above 2.5% rate over the next year or 2 years of war. So again, sooner or later, these rates, I think for me, like as I said in the past, I don't think they should come back below 1% as Trump says, but if you exclude, right, let's say you write off a recession over the next 6 to 18 months, right? If you roll out the eventuality of a recession, I would say rates have has a decent chance to get back to 3.5%. And I said the same exact thing 3 months ago. So not a huge drop, right? But if you let the market forces playing their role, I think at least 100 basis points lower than these, it could be something where we might we might be able to see. All right. So I guess, again, at this point, let's have a look at stocks and then we are gonna wrap up the video for the weekend. So while having a look at the equity market for the week, we started out the week on Monday gapping down because, of course, Trump basically over the weekend, it was uh, Sunday afternoon in here where I do live. He came back to talk about tariffs on EU, on Canada, so the market actually gapped down on a Sunday open. But again, as we've seen from the economic calendar, we've seen that the market immediately pulled back and it started to rally once again. And then, the next day we had a little bit of a drop, especially looking at the S&P, but quickly reabsorbed, and the ultimate spike down on Wednesday, it just created as if we need it. But look, it's kind of like the same on a different scale, of course. But last week I said there was a day where I saw the ES futures making a lower low while NQ didn't. And at that point, I turned kind of a bit more bullish than what I was already. It's kind of like the same in here. On Wednesday, we've seen ES futures taking out the lows, basically, of both, you know, Monday and essentially the previous week lows, right? But at the same time, what you've seen in NQ futures on the same day, it didn't even take the Monday's lows, let alone the previous weekly low. And at that point, I said, you know what? Again, same concept. There is a divergence. NQ is leading. Get ready for higher prices. And what you've seen throughout Thursday was basically that. Now, regardless of all the volatility in between with CPI, PPI, and then retail sales and all the rest, but the market was again set up to go higher. Now, Friday, it was a little bit of a consolidation day. Like overall, we've seen the market being particularly sideways throughout the overnight session. Then you got your open, and again, is another one. Look, NQ staking the overnight high, while yes, it's not. And immediately, lo and behold, they both fell below into the previous day value area, and they kept on trading below that. So it's just another thing you can look at if you want to assess the likelihood of something happening over something else, even intraday, right? Now, zooming out, I think, as we were discussing in the past, there is no reason to be bearish this market. As for the rest, we were discussing a few points, or we were highlighting a few risks for the market, and namely, if I'm remembering correctly, or you can just go and watch this talk segment for the last week video. One of those was the put to call ratio. So again, nobody's feeling the need to hedge themselves. So a lot of complacency, market which is particularly exuberant, so to speak. We, another type of risk was earnings disappointments. This week we have seen the financial sector reporting. And again, although the numbers weren't particularly good, now I'm not going to go over them. Otherwise, it could take forever. But let's just say, for the sake of it, for the sake of recapping that, the numbers were good overall. There was just a slightly component of them, like I don't know, I don't remember if it was cash flow or something, but stuff like interest, net interest rate, income, and all the rest. They beat expectations. So overall earnings were a bit, but nonetheless, there was that tiny little thing in the report that the market disliked, and therefore, if you check the sector as for the financials for the week, I think to remember it was down. Uh, just to have confirmation of that. Let's see, where was it? I mean, it was down for the day of the earnings, of course, not saying it was down overall. But yeah, I mean, you see, we got a little bit of a spike to the downside, especially this day on Tuesday, right? So, and again, another push on a Wednesday. Now, overall, at the end of the day, the market kind of reclaimed or made back those gains. It's just you never know what type of reaction you could have from earnings reports. So just be careful with that. Uh, don't get caught because you might say, "Oh, look, these earnings is actually fantastic." Yeah, but the market might look for that tiny little uh, incoherent or disappointing type of data in the entire report, and it's gonna focus on that. Markets are becoming particularly greedy even with earnings right now. They always want more, and they just don't settle for beating the forecast, but they look for guidance, they look for the outlook, and they are demanding more and more and more. Although, again, as noted last week, earnings forecasts were revised a bit lower, so the bar is always set at a lower level, therefore it's easy to beat it, right? Uh, and yet the markets are demanding a bit lower than that. Sorry, a bit more than that. So that's why we were talking about the risk of disappointment. Now, other than that, I think at the end of the day, it's hard to be bearish markets like these. The S&P just kind of retested, or at least, close enough is close enough, the 21 exponential moving average on the daily. As we noted before, the Nasdaq didn't even take out the previous weekly low. Instead, the S&P did it, and they both kept on rallying. Now, the Nasdaq is leading, as you can see. Still, if you check like the stochastics, it's still going down. But again, if it's go down, it goes down while price action it keeps on ranging or going to the upside. It's just resetting. Now, there might be a point where you see price action keeping on making new highs while maybe the RSI it's making lower highs. So you see a little bit of a divergence building up, and at that point you start to look for the cracks because this market is going up, but it's diverging on many different levels. So the technicals are starting to suggest a bit of exhaustion and all the rest. That is all legit, but as I always say, overbought conditions they can go ahead for more than what you think. Markets can stay overbought way longer than what you think. So just because you see some specific read, what you need after that, it could be a pattern, a price pattern, or a candlestick pattern trigger before actually having those divergences or overbought signals to become particularly relevant, all right? Or it could be something changing in the fundamentals, right? But up until that point, just be careful, right? Don't just follow the trend. It's the easiest thing in the world, right? I think as an aside, right? Since I think we got a bit more time here, at least I got it. There is a theme which went on for, I guess, 2023, 2024, which is the one of the Magnificent Seven, right? So the usual suspects, the Nvidias, the Meta, the Tesla, Apple, Microsoft, Amazon, and Google, right? The big cobs in the tech sector more often than not, which are driving the index more often than not, typically to the upside. Now, there was a strange phenomenon. If you look, since we are now past halfway through, 2025, compared to the previous years, what you see is that 2025 for these stocks, right? It doesn't look to be particularly cool as it was in the past. Now, they are, if you discard Meta, Microsoft, and Nvidia, but so instead of seven, you're just looking at three Mac 7 right now outperforming the index, right? The dotted darker red line, it's the S&P, as you can see. All the rest, like even Amazon, Google, Apple, Tesla, they're all underperforming. Now, Apple and Tesla, to me, like Apple, I guess it's falling a little bit behind in this AI race. So that could be it for Apple to be punished a bit more compared to the rest. Tesla, I don't think there is a lot to discuss. Like, I mean, sometimes it looks to me like it is a little bit of a shit coin or a meme coin. Not trying to diminish what Tesla is doing or what Elon Musk is doing, but I'm just saying from a market perspective and from the stock perspective, those political claims he made about setting up a new political party, or the fact that at the end of the day, Tesla is a car selling company, and if you don't sell cars, it's hard to grow earnings. And it doesn't look to me like Tesla sales were particularly good overall. So that might be the reason why Tesla underperformed at such a high degree, right? But it is just something which is curious to notice, because if you remember, 2023, 2024, they were the darlings of the market. If you check Amazon, right, which among the Mach 7 for those 2 years period, so that 2 years period, right, Amazon, which was the worst performer among the Mach 7, still performed like 22% more than the S&P, so the benchmark. Now, of course, like Nvidia with 820% type of performance, of course, performing like 780 times better than the benchmark, kind of like that, right? Crazy numbers there. But anyway, you see that they were driving the markets back then, and it looks now this theme it's starting to wear off a bit. Now, I think it's curious to notice that, but then you might ask yourself, but okay, why? What did change, right? Because if it was happening before and it's not happening anymore now, something might have changed, right? So look, one of the things you could, um, you know, pick as a justification, I think it could be volatility. When you think about these stocks, they are all high beta stocks, all right? So if you then check a chart of implied versus realized volatility, you see that compared to 2023, 2024, we got this year, especially after April, right, with retardation day or whatever, the tariffs and whatnot, we got volatility kind of being particularly higher than the previous periods. And again, since uh, increased volatility in this case, since volatility cuts both ways, right? It is true that when volatility was low and the index was going higher, those stocks, being high beta, was going higher more than the index. It is also true that if volatility is a bit higher, and it usually happens when overall the market is pulling back, right? Then those stocks will perform way worse than the index overall. Again, for the beta component of them. So that could be one reason why a few of these stocks, not all of them, as you've seen, Nvidia, Microsoft, they're all still performing particularly good. But you know, more than half of them started to underperform the market, right? So that could be a reason. And you can actually check the different degree of correlation, not only of the single stock, as for the Max 7, each single stock compared to the S&P, but also in between, among themselves, basically. So Apple against Nvidia, Apple against Microsoft. And, what you can see is that basically there was a correlation back then in 2023 of about not 0.60%, not 0.58. 2024 was 0.61, and recently that came back up to 0.77. So again, this is not to say that the Max 7 theme is dead and it's never going to come back again, but it just shows you that it's easier for assets overall to move, in the same direction when volatility is higher. While instead, when volatility was lower, let's get back to it a little bit, right? When volatility was lower, right? Even if the S&P was maybe going sideways or pulling back a little bit overall as a benchmark, the case for these particularly good stocks to keep on pushing to the upside was higher. While instead, if you see volatility increasing in 2025, and therefore the correlation as for the price direction of every single stock compared to all the others, all the benchmark, right? Then if you see in this situation, in this new situation for 2025, if you see volatility being higher and the index overall being particularly weaker, if that correlation increases, that means that those stocks will tend to follow the broad market instead of being the outliers, which keep on performing and overall keeps the market afloat, right? So I thought that was a good, or a curious, at the very least, interesting type of dynamics that we have seen. Now, as for the rest, the chart is what the chart is. You might just want to add on top of the potential risks that you want to pay attention to that. Fund managers now are taking higher than normal risk on a quarter by quarter average, right? Or if you look at a quarter by quarter type of change. So, as I said in the past, they were lagging out and they needed to catch up, right? It looks like they did, right? The problem is that they did it, but they bought in at more, well, less advantageous price or more disadvantageous. Yeah, it depends how you want to say it, but let's say they didn't bought a dip, right? They had to chase the market higher, so they didn't buy at particularly advantageous price, right? And they don't have, if you then look at the other side of the coin, they don't have a lot of cash levels because, of course, they needed to deploy everything they got to catch up with the market. So that could be another type of a risk, if you wish. From the standpoint of, we've seen that retailers, they did buy that dip, right? And now it looks like even the institutional fund managers, they join the party. We kind of default back to the good old saying, like, if everyone willing or able to buy already bought, who's left to buy? So that could, over time, again, not today, not tomorrow, maybe even not next week or next month, but it is just a dynamic which over time it's going to play a role in, building up more fragility into this market, right? And when you get a lot of different components building up fragility, all it takes to reverse the markets, it's just some sort of exogenous event or a catalyst for it, right? The underlying premise is already there. The market, yeah, although on the surface it looks like they're just going higher and higher, they are getting fragile. Do you say more fragile, more and more fragile, right? And at that point, it just take a little bit of a push to completely reverse the price action, the flows, the sentiment, and all the rest, right? So again, same as last week, this market is still pushing, so just trade the trend, trade the charts, trade what you see. Be mindful of the risks, of course, right? But nonetheless, just act upon specific triggers, right? Don't try to front run shit because you don't know whether you're early or you're late, right? So that would be it for this week. Wishing you a very nice weekend and a very good start of the next week. I already checked the economic calendar. There shouldn't be anything of particular relevance next week. If not, the usual jobless claims on Thursday, a few data on home sales, and maybe on Friday, what durable goods imports, but nothing really incredible. We got a good chunk of the relevant data for the markets this week, in my view. So as usual, be nice and be cool. We are gonna talk again next week. Nils out.
Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Get the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.